All right, before I get into an actual chart here, let me just bring up the whiteboard and go over a couple things. All right, so when we talk about price structure, and the first one is the bull and bear flags that you see in the marketplace. And you usually see these either in uptrends, downtrends, but the idea is that they actually can give you a great place to enter the market. So I'll label that like that. So what is a bull and bear flag? All right, so basically if you had an uptrend and you had a situation where the uptrend stalled and went into a slight retracement and then resumed, this is technically, all right, a bull flag because the breakout is to the top. So basically what we're looking at is for the trend to continue. So the trade is taken once it breaks the top part of the trend line, right? So that's one area, and you can put your stop at the bottom price in the actual pullback area. Now, a lot of times people will actually be in a trend maybe earlier for whatever reason here. They spot this, okay, they take some profits and go back in when it comes back out on the other side. So you see those in uptrends. You also see them in downtrends. And then they kind of resume like that. So there's your bear flag. And the same thing, you go short here after the resumption. Now, it's a lot different than when you have a trend that does this and then falls out of bed, so to speak, because what we're looking for in a bull flag really is a brief pullback. It's not a Fibonacci retracement pullback necessarily. It's usually a pause in the overall trend, okay? So keep that in mind. Any questions on the bull and bear flags? How many people have seen those? And now, actually, how many people trade those right now? So we got a big group here, so, okay, good, excellent. Okay, so keep an eye out on those, and what I would do if you're new to these types of things, just observe the market, and when you see one, see if it works, and you'll find that these work pretty well. Okay, nothing's all the time, but they work pretty well. The other thing too, I'm going to call it 2x or 3x bottoms or tops. So let's call those tops and bottoms. So, and what I look for here is a couple things because it ties in with something else. But if you have a market that's moving up, tops, pulls back, and it cannot get above this previous top and fails again, then you've got a double top, 1, 2 right there. Sometimes the market even gives you a third one before it fails. A lot of times that 1, 2, 3 tops, they're not going to be exactly the same. So sometimes they look like a head and shoulders pattern, right? Okay, sometimes they'll look like this. Market will go up, and then down. There's your head and shoulders here, right? Shoulders and head of a happy, make them a happy trader, right? Okay, so there's your head and there's your shoulders. Kind of like a triple top, but usually the head and shoulders has a more pronounced peak, so to speak. All right, and then of course you can see those in bearish markets, obviously, just opposite. All right, you can get the double bottom or the triple. All right, same thing with the head and shoulders forming at the bottom. So that is a form of, it's a price pattern, but also a form of price structure. So that's the bull and bear flags, the 2x and 3x tops and bottoms. So the other area to look for is basically consolidation, not necessarily a bear or bull flag, but actually a channel that goes sideways. So we'll call this a channel. The interesting things about channels, they're a little different than the flags. And one of the things you got to be careful about in a channel is prices can remain in that channel for quite some time, but they can also pop out of the channel frequently and change the channel's upper and lower areas quite often. And basically 80% of breakouts from channels fail. So why would you want to know that? Well, You want to see follow through if you're going to catch a trend out of a channel. But if you're a scalper and you're stuck in these channels, then you could short every time you got to the top and put your stop over here if it reverses and goes to the long side and starts trending. So you can be a scalper and take advantage of the 80% times the market goes back and forth inside a channel. And usually channels will come at the end of a trend. So if you have a big trend, you usually then go into some form of consolidation before it breaks out again. And again, a little bit different than the bull bear flags, because these would be the bull bear flags down here. In this case, it would be the bull ones. And then this would be an example of a channel. So a little bit different. All right. Any questions on those three? Yeah, the channel usually is a sideways movement. It's usually sideways. Okay. Whereas the bull and bear flags are like a diagonal. We'll take a look at some real charts in a moment. Let me just go over one other quick thing to know. So, you know, whenever you look at a market, the market moves in waves. And of course, we've talked about these waves being Elliott wave. So, you know, moves up, pulls back. Usually this is where we see a bull flag rather, pulls up again, tops, usually gets some type of head and shoulders or top, and then it reverses and goes down. But it's always moving in waves. So the idea when you see these waves is you don't want to get in necessarily up here. You kind of want to get in down in this area here, all right, before it moves up. So that's kind of what you try to do. And the hard part, of course, is you want to make sure the trend is still up and not down. Okay, that's important as well. So that's, you know, a situation where are buying at the troughs, okay, and riding it up, and perhaps, you know, selling some here when you get to be a more experienced trader, and then buying back in if the trend is not complete. And certainly when you have a wave structure like this, you know, you can just draw a trend line. You don't need fancy software for that. Just draw a trend line, and as long as these trend lines hold, and you have a bullish flag, then that's actually an ideal place to enter. Whereas if you wait for a channel breakout where you have an 80% failure, you still need to see some follow through before you can get excited that it is an actual trend. So one of the nice things, again, about the bull and bear flags is that the trend is usually already in place, and you're seeing a pullback, which is usually like going to be represented by an Elliott wave of some degree, and then a move back to the upside. So that's kind of a neat thing. And sometimes you see these bear flags inside the major impulsive waves because they represent the smaller waves inside, that type of thing. Again, what I would recommend doing is taking a look at some charts when you're trading and see if you can spot these types of characteristics in the markets and kind of get used to them and see how you could play them for profit, all right? Because you definitely can do that. Sometimes in a trend, all right, here's a price bars. Let's say you had a big uptrend like this, and you have something like this that kind of falters. Usually in the trend, you'll have a major price bar, and sometimes you'll have a little bear flag. And if that bear flag is hit and you get an entry, usually the next short-term top or major top is going to be the same distance as the biggest price bar in that first move up. And that is what I found. So it's almost like a one-to-one risk to reward in terms of where prices are going to top. So this can be another area where if you're getting in on a bull flag here, okay, here's your trade entry here, then chances are you're going to be able to ride it up to this area based on the largest price bar and then taking the same distance of that price bar and projecting it upward. That's usually going to give you the price level of where that's going to go next. It's kind of a neat thing. Let's go to a chart here and just take a look at a couple things. All right, so no indicators, no nothing. So this happens to be the NQ on a 5-minute time frame. Here's the 25th, the start of the 25th, which is today. And here's where the market basically opens up here in the US. And you usually get quite a significant movement after that open. All right, so let's just take a quick look at things. So, here's the ground zero. That's the starting point. If we took a trend line and drew a trend line up from here to here, and then a shorter one from this level here to here, you would see that really when the market opened, it was still in a trend. But notice these little pullbacks here. Okay, you had actually a big one here, but notice these here. What are those? And there's a lot of them. What are those? We'll see if you were paying attention. They're flags, right? So when prices jump out of that range, those are trading entry opportunities. And the long trade makes sense there for a variety of reasons. The breakout is obviously on top of the flag, but notice the trend lines are still up. Kind of interesting, right? Now, look at this big price bar here. If I was going into these here, if we take a measuring ruler here, here's a price bar in the middle, and let me just redraw that. Okay, so if you go into that trade at that particular point, the chances of it reaching that level are pretty good. Now, that doesn't mean you're not going to have any pullbacks on the way up to that level, but the trend should not change up into that area. And sure enough, we hit it up here. But also, too, we had more come in, right? You had one big one right here. And prices reached up there. And again, it's not exact. It can exceed it or just be short of it sometimes. But it gives you a great little reference at times of where prices are going. And we even had another one here, right there, okay? So when you take a look at some of the ones forming along the way, you can get a more accurate range of where this thing should top out or at least go to. So that's kind of a very handy and I think very quick way in which you can gauge approximately where this thing should go. Of course, you can use fib extensions and things like that, but if you're trading a very short time frame, it's very helpful. Okay. Now, the other thing, I'm just going to erase all the trend lines and everything. All right, the other thing too is obviously if we're trading this and we reach a top up here, we kind of know at that particular point, if we start to see a pullback, then it's also possible we could get a fib retracement pullback and that particular big move up is over. Now, here's what I want to show you here. When you get more than 3 peaks after a bottom, so 1 peak, 2 peaks, really 3, then you're kind of getting into an area where you got to look for a pullback. But in a case like this, because at that particular point you took out the low, all right, of the ABC or 1, 2, 3 retracement that formed the bull flag. So at that particular point, the trend now is down, and you would draw your trend line down at that point. And 1, 2, 3, and probably a bottom. But here's where fib retracements can help too. So if you come here and draw a fib retracement, especially if you're using the art software and you have the owl and everything else, it's going to tell you when it's going into a wave 4, but you can expect prices to come down here to this area. So you really don't want to go long until you actually get some type of bottoming process in the retracement areas. And then look what happened. You had 1, 2, 3 bottoms. So those are our multi-level, like double tops, triple bottoms. But also too, the other thing here to take home with that is that we had a congestion area from here to here. And so that is another thing we look for when we're thinking about going along after a broad pullback like this. We usually see prices go to a former congestion area. So this congestion area down here actually is both support and resistance. So it's resistance on the move down here, okay? And basically, you know, if prices went below here, then it would be a support level on a downtrend, but they didn't. So instead, you had 1, 2, 3 very long wicks on all these bars, indicating that the bears tried to push it down, right? But they couldn't hold it down. They couldn't change the trend. So as soon as you see this big price bar up here, okay, then that's kind of a clue that maybe this is a good bottom, but you still haven't gotten above here yet. You get above here, there. So if you went long here thinking that's a breakout, your stop's got to go at the bottom, because then the pullback comes down here. Now, again, if you feel that once again you're in an uptrend by being able to draw the trend line again, well, you could wait on this, not take any trades in there, and instead do what? Wait for the market to pull up significantly, and then you get a bull flag here. And then there's your first entry off of bull flag. So you can wait for bull flags to make your first entry on any trend, and it will be a safer bet. The problem with going in on your first breakout is you got to put the stop at the very bottom, and it's a long way down there. Okay, so the loss will be quite large if you put it down there. So you'll have to have a small trade size. At least with this here, you know, your stop loss can go under here, and your trade size can be a decent size and a nice clean entry in time for the next big move. And again, the market closed here, but probably if the market had stayed open, you probably would get up to this area here because of that price bar being so big. Probably go on to making a wave 5 top after that. Relationships of 1 to 1. This is not necessarily the end of the trend. It's just the next power move up, surge up, should go to that area before you see another type of pullback. This is the kind of information that Al Brooks teaches you as well, all right, in his course, this type of information plus a ton more. But it's really excellent stuff that he goes over. Is that basically when you have a bullish bar like this one, you buy, okay, and the stop goes under there. And then bullish bars, buy. So you're constantly adding into the trend and then taking profits when you get your first reversal. And he goes into more of that as well. I wanted to just give you an overview, and this is just the tip of the iceberg also of what we're going to be going over when you come to Tucson, Arizona for our tutorial, because we're going to be actually doing this on live markets. This is price action with absolutely no indicators or software tools. All right, well, that is it for this week. You guys have a wonderful week, and we'll see you back here next time. And again, thank you for coming today. Great turnout, by the way. Definitely check out Al's course. Use that link I gave you. Best money you'll spend. Very reasonable for the amount of instruction and detail he gives you. He also goes over a lot of statistics on things as well. So kind of neat. And I'm going to put his link up here as well. He's got a great course. I've taken his course myself. It's all on price structure, things that he has learned in his trading days. He's been around for as long as I have. So he's been around the block. He used to be a surgeon and then got into day trading. And basically, he doesn't really use indicators. He uses just price. So it's kind of cool to learn that. The course is, what, $3.99, but he gives you 132 hours of video, and some of those videos, of course, are him actually trading. So definitely check that out.
Serving traders worldwide since 1998, TradersCoach.com provides educational services for traders and investors alike. We've developed trading software to help traders of every level improve their skills. Our site is dedicated to providing you with all the resources, software, and educational material you need to achieve your trading goals. It is because of our years of experience, attention to detail, and our exceptional customer service that TradersCoach.com is the right choice for you. Call us today.